Is it 1999 for the bond market? I'm Jack Otter, editor of Barrons.com. I'm here with Patrick Dwyer, who is a wealth manager at Merrill Lynch and a top Barron's advisor. So you've got an interesting idea, Patrick. You look at the bond market and you point out that it's been a long time since anyone actually lost money in bonds, and it's time they ought to prepare for that possibility.
It is. Whether you think the bond market's going to stay the same or go down, I mean, if it stays the same, most of my clients actually can't get an acceptable return from the current fixed income market to meet their goals and objectives. Most of my clients, they need a 6 to 8% total return on their portfolio over the next decade. 2.5% return on 10-year Treasury is not going to help them meet that objective. So I think there's more risk in the bond market than most investors actually perceive. But that's really because, as human beings, whatever our most recent experience has been, and our most recent experience, the last really since 1982, our experience in bonds has been absolutely fantastic. And so, I mean, who has had a bad experience in municipal bonds? Nobody has. In the same way, I can remember in my career in 1999, the way people felt about large cap blue chip stocks. I mean, people said the same sort of things. They said, this company will never go out of business. General Electric will never go out of business. They will never stop paying a dividend. And they were right. It's true. It was just really overvalued, and they lost a ton of money.
Yeah, so $17 in paying a dividend is not the same as $62 in paying a dividend.
And I can remember having that conversation with the General Electric executive at that time. And at that time, you could buy a 10-year Treasury at 6% risk-free, and nobody wanted to buy it. And so today, if you kind of, it's sort of the world's upside down. 14 years later, you can get 2% on the S&P as a dividend and 2.5% in a 10-year Treasury. Clearly, I think that there's more risk in the fixed income markets, even if you have a sort of view that the economy is going to grow very slowly, than people realize. Either that risk is a long-term risk that you're going to have a very, very low return, and that's not going to be acceptable to the investor, or you're going to see a little bit of a rate shock. And my view is that there's probably going to be some challenges in the bond market next year, because I actually think the economy in the U.S. and even in Europe is picking up a little bit faster than people really expect.
And so in terms of what you're doing in your portfolio, in reaction to this, you said you have gotten somewhat out of the municipal bond space, but you've found some fixed income funds that you like better at this moment.
Yeah, well, first of all, I love municipal bonds, right? And I just don't love them at these levels. So I want to clarify that. And there's nothing I would rather have than a portfolio full of 5% yield to maturity municipal bonds. That would be wonderful. But that doesn't exist today. So what we did last year when we saw that little rate shock last year was really amazing to see how quickly the spreads on municipal bonds widened. And what most investors don't realize today is because of the Dodd-Frank rules, the banks, the big banks that trade municipal bonds, really don't put a lot of capital up on their bond desks. So when you actually go to buy or sell a municipal bond in a difficult bond environment, what you're going to find is it's going to cost you a lot of money to trade that bond. Could be 2%, could be 3%. And an investor...
You're referring to the difference between the bid price and the ask price.
That's right. Because what you want to do, if rates pop next year, let's just assume that the U.S. economy continues to improve, and let's assume for a second that Europe is a little bit better than people think, that it actually is continuing to creep along. I think there's a chance that what we'll have is a reaction in the market. And I think that's going to create an opportunity. And when I think most investors think, well, I'll take my bond portfolio, I'll take losses on my municipals, and I'll buy longer dated municipals with bigger coupons. Well, that sounds great, but you'll probably lose on a high quality bond if the 10-year Treasury goes from 2.5 to say 3.5. You'll probably lose 7 or 8% right there. Then the spread on the buy and the sell will probably cost you another 5 to 7%.
Ouch.
That's a big loss on an investment that really has very low, basically is barely giving you the rate of inflation. So we've taken a little bit different approach. Last year, as the bond market improved tremendously towards the end of the year, we liquidated a lot of our municipal bonds. And what we've done is just buy a big basket of what I call flexible fixed income managers. And these are basically bond managers that are relatively low cost, that have a lot of tools in their toolbox, generate about a 4% taxable yield. Right? After tax, it's actually about the same as what our municipals were paying us on a yield to maturity basis. But we can sell them at 4 o'clock and get NAV.
What sort of strategies are these? But this is say a PIMCO income fund. It's not a hedge fund.
That's right. These are something like the PIMCO income fund. There's a lot of funds that fit this. We actually have about 11 that we're using, and the reason we're using so many is because there's no benefit to just owning one. And some of them are going to get this right, some of them are going to get it wrong. But these managers basically are generating decent yields. They're using some hedging techniques to protect them from rising rates, which should help a little bit if they in fact go up. And if we're wrong, we're getting about the same coupon as we are on the municipal. Probably taking a little bit more credit risk, than we are in a municipal bond. But we think that opportunity will present itself sometime in maybe next year, maybe the following year. And when it does, we intend to sell these bonds, these bond funds, and turn around and purchase municipal bonds when everyone is selling them. And I think we'll get some great buys. And our sort of target price is we'd like to buy 10-year munis around 4%. And while that seems an awful long way away from today, if you look at the numbers last year, there were some incredible prices for about 3 weeks when people were panicking. And so we're just looking for that type of an opportunity.
It's always good to be a buyer when others are panicking.
Right, but the problem today is that you can't really hold cash, and so that's the challenge for us. Is that if your client needs have specific return requirements, holding cash and earning 0 when inflation is 2% is also really painful. That's a bet in and of itself. So clients need to earn something, and that's why we're using like J.P. Morgan Strategic Income or the PIMCO Income Fund and funds like that to generate a return, but preserve our liquidity, the ability at 4 o'clock to sell and get a good price.
Thanks very much, Patrick.
You're very welcome.